is Amazon.
Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today we're going to take a look at Amazon and what we did last week, and we'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest and author of The Options Playbook. All right, so this week I am traveling. I am on the road. And because of that, I decided to just basically take a deeper look into the Amazon stock split that occurred while I was traveling. So Amazon is one of the most widely held stocks within Ally Invest. So, and it was a fairly complex stock split that happened. It was a 20-for-1 stock split, which is a big split. And a lot of times, last time Amazon did a split, it was actually a 2-for-1 stock split. So that was back in 1999. And that was one of the things that we were joking about last week in our title, that Amazon was splitting like it's 1999. So this week we ended up looking at a long call spread, and we kind of billed it as a FOMO trade because Amazon was splitting, but the options when we did the trade were still very expensive, obviously, because it was prior to the split. So I'm going to work through the dynamics of it, and I'm going to give you an alternative trade for Amazon. And that's going to be the stock play of the day for this week. That's going to allow me to get back, and we'll be next week, we'll start with a fresh trade. So what's going on in the markets? Right now I'm highlighting my VIX watch list, and a couple of weird things did happen this week in that the VIX, once again, is just kind of confusing to me, the reaction that it's been having in the marketplace. Let me put the VIX up, and we had an up day the other day in the VIX, in the S&P 500 index, and we saw the VIX actually increase in price. Now, the VIX isn't at any high level by any means. Let me add it to the chart here, down around the 25 level. But when we've had up days in the S&P 500 index, and you see the VIX also go up, a lot of times that adds more uncertainty to the marketplace. But here's where the VIX is at, down around the 25 level. As far as the 200-day moving average is concerned, we are a little bit above that, but we are not by any means in a high volatile environment relative to the actual volatility of the S&P 500 index. So one thing that is staying true is that the 10-year is now trading right around 2.9%. It's staying below that 3% level, which means the 10-year doesn't necessarily think that the Fed is going to be more aggressive than what they are implying. Target today came out with some bad news as far as inventories are concerned, and that they say they have too many appliances on hand and that they're going to actually have to have a fire sale. I guess I'm paraphrasing. And if anything, that's going to bring down some of the inflationary numbers. And so they're kind of helping out the marketplace a little bit. We're still seeing the 10-year trade, at a decent interest rate level. So who knows, right? We're still at this precipice. The VIX is showing that there's not a lot of nervousness in the marketplace relative to the actual volatility and what's actually happening with the markets. The 10-year is staying below the 3% level, but we still haven't seen that sustained pop. We get a couple of good up days in the S&P, and I'll add that little chart right over here. We get a couple of good up days in the S&P 500 index, and then we get a down day. And so I guess the word would be chop if I'm just thinking about the indexes and where the markets are at. But that's not today's story. Today's story, we're going to do a lot of math. We're going to figure out what exactly happened with our Amazon long call spread last week. And we'll discuss an alternative trade, something that you could do in the Amazon trade if you stayed this long, because ideally we were doing it for the split. We had the split that occurred. Amazon had a good run up on the morning of the split when the stocks were trading at the new lower price. I'm struggling with a phrase to say, when the stocks were trading at a new lower price. So ideally, you would have been out on the day of the split shares. That would have been Monday. So, all right. So here's what we looked at doing. We looked at doing a long call spread. We were a little bit out of the money last week on the trade when we were looking at doing the trade. Amazon at that point in time was trading around the 2,400 level. We did the 2,400 strike call. That's the one that we bought. And we sold the 2,480 strike call. And that was with the June expiration. So on our long call spread inside the options playbook, strike A was 2,400 and strike B was 2,480. Amazon equivalent, if we took the price of the stock, it was at 2,375. If you divide that by 20 at the moment that we were doing this trade, Amazon then was trading around 118.75 when we put on that long call spread. Split adjusted, it'd be 118.75. The strikes, the 2,400 strike would be the 120. The 2,480 strike divided by 20 would be the 124 strike. And we went through a lot of detail on making sure that when the split occurs, we're not going to end up with an odd fraction in our strike prices. And part of that rationale behind that is, if you have the nice round numbers, people are more apt to trade those option contracts, just human nature. And a lot of times it can be a little bit more liquid option contracts. Now, we did emphasize that it is Amazon, and all the strikes will probably trade pretty liquid, will probably be pretty liquid, have decent bid-ask spreads, but why even worry about it? So we came up with a 120, 124 strike long call spread with the June 17th expiration. Okay, so let's look what happened in Amazon. Here's the Amazon 15-minute chart. So the trade, this was the day that I headed out on my travels. We did it in the afternoon. Here is 12 noon on Tuesday on the 31st. These are 15-minute bars. So this is all day Tuesday. This is all day Wednesday. This is all day Tuesday, Wednesday, then we get Thursday. And then on Friday, this is the day of record. This is actually the weekend when all the back office work gets done by all the clearing firms to make sure you get your split adjusted shares, which means if you had one share of Amazon, you're going to wake up Monday morning and you're going to have 20 shares as far as the books are concerned. Now, if you had one option contract, that also means that you're going to have 20 option contracts. Here is the open after the split adjusted price. And you see that the chart is showing that also, that right now we're at 122. So the chart has been adjusted for the split. Had a good solid run up as far as the chart is concerned, all the way up to 129 by 11 o'clock. Now, remember, our strike was 124. So at that point in time, even though we had the June 17th expiration, we still have some days for this trade to live. I would have definitely had a good till canceled sell order in. The maximum the spread could trade for is the width between the strikes, which is $4. So I might have had that in at 375. Just kind of hoping, I'll give them the last quarter on the trade. And in that instance, if I would have done that, you might have got filled right on the open on this trade. If you did not, though, the stock did come down. There was another opportunity, made a little bit of a bounce back up down to 124, made the bounce back up to 126. This is all day on Monday. And right now it's actually came down. The markets are down a little bit today, and we're at the 122 level. So an interesting ride. Interesting in how all of the back office work that was done over the weekend. There were a lot of people making a lot of overtime this weekend as far as the brokerage firms were concerned. Amazon, to recap, Amazon was at $2,375, give or take, when we put the trade on. Split adjusted, that would be $118.75. The strike that we bought was the 2400 strike, so that becomes the 120. And the one that we sold in our long call spread was the 2480 strike, so that becomes 124. The price of the spread of the paper trade, now I always want to emphasize these are paper trades, they're not meant to be recommendations, but the price of the spread was at 32.50. And if you divide that by 20, that means that the spread price should have been right around 163. That's 32.50. That's 163 is where the actual 4-point wide spread would have traded at. Okay, so now let's go in to the Ally Invest option chains, and we will look at the actual split. Okay, so right now Amazon is at 122. We did the June 17th expiration. Here's the 120. I should say spread, not split, but here's the 120 strike, and here's the 124 strike. And we now see this trading at 205. So when we put on the trade, it was 163. If split adjusted at 163, it's now at 205. But don't forget, instead of having one contract of our 1-by-1 spread, we now have 20 contracts. So basically, if we're going to trade this, we would go in and we'd go 20 and 20, and we click the trade button here. We're going to have to adjust this a little bit. And if we were to just be selling it right now, we would be doing a 20 lot, sell to close. The sell to open would become a buy to close. And we'd say a net credit, let's say 205 to the account. That's a nice round number. We tried to work the midpoint, but we do see that the spread is fairly decent. It's 8 cents wide for the two options. 201 is the bid. That would be the current market rate. 210 is the ask. That would be the best case scenario. And we would try to fill it somewhere in the middle. 205, I think, would be a very solid credit. There's a lot of activity in these options. I would want to get somewhere close to the midpoint if I was entering this trade. So that's how you would get out of the trade. So very simple. Well, I don't think there was a lot of simpleness in there, but we looked at picking strikes that would not have fractions in it. We ended up with a 4-point wide spread. When we started, we were 80 points wide. And just for fun, I went out and said, okay, we paid $32.50 for the spread. If you took the new price, the 205 price, and you multiplied that by 20, that means that spread would actually be trading for about 41.40, right? So if you did the reverse split and you went in and said, okay, when we first did this trade, the spread was at 32.50. It's now at 41.40 for that same spread. Or you got 20 contracts and you're looking to sell it at 205. So over the week, that was a decent profit, but you could have done better, right? We could have gone all the way back to this little moment in time, which you did have a lot of time because it had a good solid move up. A lot of times I like to look at about the 10 o'clock hour, the 11 o'clock hour after a major news event to just kind of see where the stock is settling in. We then had a little bit of a sell-off So you had the opportunity to get out at a little bit higher price. Right now, the trade is doing just fine though. Okay, so at this moment, I'm going to say if you would like to put in any questions in the chat box on this, there might be a ton of them out there because the split wasn't a simple one to break down. Math wasn't that hard because it was at least an even number doing a 20-for-1 split. But if you have any questions about what's going on right now or anything, please put them in the chat box and I'll try to address them. But with that said, I'm going to actually look at an alternative trade today. Not that we really need to. The trade is up. You could get out of it. But there's sometimes when I do a long call spread, I do like to roll them into butterflies, which is an advanced scenario. If you kind of fell asleep on the split adjusted day, then you wake up today and you're like, oh, I coulda, shoulda, woulda. And if that's the scenario, maybe you want to try to squeeze a little bit more out of this June 17th expiration option strategy. Okay, so here's the trade that we're going to actually look at. We're in that long call spread. We're going to consider rolling this into a butterfly. So I like to roll from call spreads to butterflies back to call spreads. I only like to adjust a trade once. I don't really want to adjust it more than that, especially on a shorter term trade. And so what we're going to do is actually sell a short call spread, and we're going to add that to our position. And when we're all said and done, we're going to have something that looks like a long butterfly with calls. This is going to be our resulting position. We're going to take some money off the table. We're going to hope that Amazon has a little bit of a move up. And by doing this, we should be able to get this butterfly done for free. We should have no cost on the trade when the butterfly is all said and done. So let's do it. Here's our trade. This was our closing trade. And this was our butterfly. So let me get rid of the right rail, the paper trade rail, if you will. And we're going to adjust this trade by selling one more 124 strike. Now, it's fairly important that you keep it is important that you keep the width of the strikes the same. So we're buying the 120, selling the 124, and then we're going to go out and buy the 128. All right. So in this instance, you have a 20, and you're going to do 20 more of them, and you're going to do another 20 of these. And so in this scenario, this is the trade that you're going to have. Now we're going to have to add on that trade. Right now, the butterfly is trading for a net debit of about 70 cents to the account, 4 points wide. And I'll just show it in the profit and loss graph. So this is interesting. The profit and loss calculator is kind of fun to work through these scenarios because you'll be able to see how I'm showing it graphically in the options playbook, where we went from a long call, looked at a short call, and then finished that in a butterfly. So let's go and look at this trade. So if we put this back to 20, and we remove that leg, now you see our long call spread graphed out in real time on the profit and loss calculator. Okay, so what do we do then to adjust this trade? 1 second, I need to get the questions up. To adjust this trade, we then come in and we sell an extra 20. So this will end up being well, let me get rid of this leg. We'll add this leg, and there you go. So this will be the trade that we're going to add, and that's our short call spread. All right. And then lastly, if we click this box, add the additional 20 here, this is the trade that we end up with, which is our butterfly. So you can go through all the scenario, and you can see the dotted line showing you the profit and loss graph at expiration on all of these different positions. Okay, so here's what the trade would be. So let's go on up on top. I'm going to clear this out. We're going to sell the 124 and buy the 128. Okay. Let's go back in here. And if we sell the 124 and buy the 128, this would be our adjustment to this trade. And I'm not saying that we would necessarily do this. I'm just saying it's an alternative. There's an opportunity because it was basically missed, right? If you did not get out on the open, the market is down. So now what can I do? What can I do to try to take some money off the table and put the trade on? And the market has moved a little bit more. At one point in time, it was trading really close to the 163 that we paid for the trade. It's now 130. All right, so you're going to have 30 cents worth of debt. You would bring in $1.33 as a credit, but we're going to bring it in 20 times now, if you remember that. We paid $1.63, so we still have 30 cents worth of risk. And we just want the market to come back up and sit right around the 120 by that June 17th expiration. This would be our trade alternative. And I would ideally want to do this. If I was going to do this trade, I'd want to wait and try to get the net credit close to what I paid for it. I don't want to have any risk on the table if I'm going to make this adjustment because we already have a profit, right? So this would be the official adjustment paper trade. We'll go 132 net credit somewhere at that midpoint. And you'd have to do it 20 times. And you would end up with a 20 by 40 by 20 butterfly spread with the June 17th expiration, hoping that that underlying stock is going to go to the short strike of 124 and finish fairly close to that by that expiration date. All right, so I have the Ally YouTube up. And if you have questions, please put them in and I'll address them and we'll call it a day until I get back to the office to do this one more time. All right, so I do have one question from a username that I cannot pronounce. It's basically alphabet, something with a pine cone. Could you play a credit type spread with this scenario? Could you play a credit type spread? Yeah, you could. I don't. What we were doing in the setup of this trade is it was kind of a fear of missing out. The markets have been scary. We had a very expensive underlying until that split happened. So how could we get ourselves in a position where we had more upside than downside? And usually when that's the case, and I'm going to click on it inside the options playbook, you're going to have a long butterfly spread. Or I'm sorry, not the long butter. You're going to have the long call spread. Okay, let me get to there. And so when I'm setting up a trade where I want to have more upside than downside, especially when we're talking about it, there's many different ways in the options world to come up with a specific risk profile. To me, it's the simplest to do the long call spread and say, here's where I'm going to go. I had an 80-point wide spread when we put it on, and we're going to pay about $30 for it. So we're going to get 50 points of upside and we have 30 points of risk. That was $3,250 for every 1-by-1 spread that we did. And that's the scenario. When it's that scenario, and there's a known news event that's happening, I prefer to do a long call spread as opposed to do a short spread where I'm selling it and I usually bring in a smaller credit and have more risk. That wasn't our goal with this trade. And that's what the stock play of the day is all about. We're looking at how can we take all of the 40 plays inside the options playbook and look at scenarios where the long call spread might be more of a consideration than doing the short call spread, right? So a long answer to a short question. All right, so if you have any more questions, please put them in the chat box. Let us know. This is the last call for questions. And if not, well, thank you all for coming. Amazon, we got another stock split that's going to be happening here on another mega cap in Google going into July. So we'll have another stock play of the day and we'll talk about the Google trade. And please click subscribe, ring the bell. Please share this with friends. And we'll see you this coming up Tuesday for the next stock play of the day. Thanks for coming, everyone.